CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for July 20th, 2020. Please see our disclaimer for important information. So in our first slide tonight, we're going to revisit some data that we first showed you last week from our friends at First Trust up in Chicago who are polling from COVIDtracking.com, and this is just a visually enhanced depiction of several things that you've already read about in the press, that being the rate of hospitalization related to COVID-19 as well as deaths. And so again, those blue lines, blue bars rather, that you see are the aggregate deaths, reported daily deaths from COVID-19. As you can see that they trended down a little bit after the reopening and have kind of upticked lately. And also you can see in the gray bars on top of that the hospitalizations that have been reported. And obviously that's a stark number that's getting a lot of press, but the amber line that divides those two is the deaths as a share of hospitalizations. And so that number, or that line, that trend rather, has been more or less flat with a slight uptick, and this is a 7-day moving average. So here just in the last week we saw that slight bump related to some of the increase in the aggregate number of deaths in the second week of the month, but that number has since trended down. But really the key takeaway here is that we're not seeing, at least for now, a commensurate uptick in the rate of deaths as a percent of hospitalizations, even as that hospitalization number has gone up. And obviously I think hospitalization should be concerning to all of us, but death rates are not following suit, at least in the time being, for a multitude of reasons. Perhaps one that's been offered is just that we're having a younger cohort now that's being infected that is not requiring hospitalizations, and the fact that some of these infections are being treated sooner, and so they're not getting to the point of hitting ICUs and things like that. So they're being treated out of ICU and just into the general hospital, I guess the general hospital protocol, if you will. So I wanted to talk about a couple of economic factors that have kind of been topics on the margin, if you will, here lately. And we're going to talk about some of this stuff in our market minutes that is a sister kind of webcast to this. But you can see it depicted in the charts that, at least from an inflation standpoint, obviously we don't have it. We know that we've had disinflation as of late. And it's really been a lack of demand. Now, obviously in some sectors like consumer electronics and things that you can buy on the internet, you've had a surge in that, and actually some staples, if people are spending more time at home, etc. But for the most part, we've seen inflation trending down. Now, we did have an uptick, as you can see in the lower left, here in June, and we want to pay attention to that because the data has just been in so much flux because of COVID-19 and the forced shutdown that we've got to be careful in extrapolating a trend. We know that there are risks out there on the margin for the economy, for the sustainability, and we even think that the data perhaps in for later this month that we're going to be hearing about in in August, maybe a little less optimistic, may actually show a little bit of a slight reversal in some of the measures, just because we've had this surge in cases and we've had some new restrictions in key states along the Sun Belt being imposed or reimposed, if you will. And so even though the world in general has seen a fairly strong disinflationary push, our rates have followed suit. We want to make sure that we're not overthinking this, and that, with production having come down, and I had another chart that I didn't put in this week's package that showed industrial production going down quite a bit. So if you have, an increase in demand for less supply, that could drive prices up. And that's something that we certainly want to take into consideration in investment portfolios and make sure we're not going to miss that inflationary push. Now, we do think the Fed, for its part, is going to let the economy, they're okay with letting the economy overheat if this is a reversal at some point here in the next 6 to 9 months. And they're okay keeping rates low and letting inflation kind of heat up a little bit before they make a bold response to that. Now, this is another chart that, at least data that has received a lot of press. What we're looking at here is retail sales, and this is food and services and other retail, including things like consumer electronics, clothing, apparel, and obviously we were in a fairly strong uptick with a reasonably strong consumer with, even though relatively tepid growth in earnings, average hourly earnings and compensation, that number was really kind of a slow slog upward. But clearly, COVID-19 hit and we were retrenched, but, we've largely regained the aggregate level that we had prior to COVID, or at least we're very close to it. Now I'm going to get into some kind of other economic health indicators that I think we definitely need to pay attention to. And the first of these is, speculative downgrades of corporate paper. And, what I like to say is that this is clearly something that you'd expect, not only in a downturn, but also in a recession. Obviously, the strong dislocative factor of COVID-19, you would expect the forced shutdown to create some significant stress on businesses. And not every business, of course, has the AAA credit rating, and most of Middle America, does fall in that that triple B minus, perhaps double B level, where they're not particularly strong credits, they're not particularly bad credits either, but they're speculative grade. And you've seen even more. You've seen a strong spike so far here in the second quarter of 2020 of the downgrades. Certainly much more than you've seen upgrades. But as it says here in the headline, downgrade to upgrade ratio is close to its all-time high. So that's just one indicator of kind of the health of middle American business that we definitely want to continue to monitor. And this chart kind of dovetails on that. So obviously we've seen a spike in the number of bankruptcies, and we've obviously seen a lot of increased borrowing as there's been a a kind of rush on the bank to get easy credit at a time where people are clamoring for whatever liquidity that they can for their business. And so this chart just shows you kind of what's already intuitive, but the fact is that if you look back at the prior spike, which is in the early 09 time frame, kind of the pinnacle or the peak, if you will, of the stress in the market related to the global financial crisis, that we're basically at the same level now. And this hasn't probably received the ample amount of press that it should, but this is one thing that we need to monitor. Because as we're trying to rebuild or reconstruct some of these lost jobs that have been essentially destroyed or vaporized in COVID, that it's going to be important for us to hopefully moderate the rate of bankruptcies, because these are the people ostensibly that are going to be hiring people that are unemployed right now. And so obviously if you continue to see stress in the corporate sector where they're having to, they're having to file for reorganization or for liquidation, that they're not going to be in the market to hire. So this gets back a little bit to commercial real estate, which we've talked about a little bit. And obviously the future of work and the future of the office environment is something that I don't think any of us have an answer to now. We're just going to see the trends. I think there's a lot of speculation that, that there is a certain cohort of the workforce that is comfortable working from home. That we know a lot of tech companies have said, perhaps half of their workers are going to be permanently working from home, and so, that is obviously putting stress on all of these sectors. And so this chart depicts the month-over-month delinquency rate by certain property types. And so I think it's fair to say that there is stress in all of the key office and retail areas, and I'd say in particular retail. And I think retail is going to be an ongoing trend. I think, we have seen a fundamental change in how the world is going to view malls, I think, going forward, just because of the forced online purchasing that we've had to move to here over the last several months. But you see less stress on multifamily, but clearly on retail, and clearly in perhaps the hospitality sector. But office, I think, is something that if we continue to watch this chart evolve, you're going to see office pick up in a reasonably profound way. Bankruptcies. Again, the stress on the corporate sector, I think, owing to that last chart about the stress on retail-related commercial real estate, you can see consumer discretionary there is the largest slice of this pie, and these are simply year-to-date bankruptcies by sector. So energy is intuitive because of the decline in energy prices, despite the fact that energy prices have kind of battled back from their negative level, which was unprecedented several months ago. But energy sector remains stressed. And you can see a lot of weeding out of the weaker players, but also in not terribly intuitive has been the stress placed on healthcare and on financials. And I think the financial sector is going to play a little bit of defense going forward. You're going to see, I think, if we get into a little bit more of if we're not able to shake this COVID infection trend, and we get closer to the point of having, the dual risk of an influenza season with a second wave, I think you could clearly see lenders begin to pull back on credit, make credit much tighter, and then perhaps even see financials be a slightly bigger piece of that pie. But anyway, you could see that. Long story short is that there's really no particular sector within the market that is unscathed in terms of bankruptcies, but clearly the consumer side has been the most touched here. This is the high yield market. It's a little bit of a busy chart, but it's a screen capture from Bloomberg, and this kind of goes to my comment not too long ago about companies clamoring for liquidity at a time where they're uncertain about the future, and they want to maintain either to sustain current operations, where some, like say the airlines, are operating at a loss every single day that they open up for business, or other companies that are simply just trying to stockpile liquidity at very low interest rates. But either way, you've seen the speculative grade borrowings really kind of shoot through the roof, and this is going to be very interesting to watch. Obviously, we've had a lot of speculative downgrades, as we saw in the prior chart. We've got stress on credit, and of course, downgrades to the issuer imply that they're going to have to spend more. They're going to have to take on a higher interest rate to offset the lender for the increased risk, perceived risk, and at the same time, companies are clamoring for this liquidity, and I would expect to see that lending number go up for at least a period of time within the high yield sector. And there's obviously, from an investor standpoint, this is indicative of a lot of supply now hitting the market. So these high yield loans are now going and hitting the market. And so you can buy those in an ETF or in a mutual fund. And so there's an increased supply of these things that have higher interest rates that you could get if you just put your money in the bank or put it in a CD or whatnot. And so there's a fairly strong demand for high yield paper right now. But as you can see, supply is satisfying it for the most part. And really, I think as we get towards the end of this package here, we're just going to talk about earnings a little bit because we're in the midst of hearing from companies in all the sectors. For the S&P 500, we're getting lots of forecasts, lots of, I think, cautiously optimistic guidance and a lot of caution in other guidance. And we're hearing from people that are beginning to cut their dividends. And we're hearing from people that are really kind of almost not giving guidance just because they don't know what the fall is going to look like. But as you can see here, this is from IBIS, which is a service which aggregates earnings estimates from the various analysts that write research on companies. And I used to be one. I used to submit my earnings estimates for the companies I followed to IBIS, and they would aggregate it together with all the other analysts. So this is kind of an average group think, if you will, of what's going to happen for earnings in the index as we kind of exit this year. So we're in the second quarter. Obviously, we know that those earnings are coming in fairly poor, and then they're expected to moderate basically through the remainder of the year. So fourth quarter, by this judgment here, will be the last quarter that will have negative year-over-year earnings, and we'll get that feedback probably January, the latter half of January and into the first week or two of February. But then, as we get into the first quarter, and particularly the second quarter of 2021, the estimates are looking fairly strong. And I think as we've seen in the past that we have had fairly optimistic earnings that then, as you get closer to that particular quarter, they kind of pare down a little bit, and people get a little bit more conservative to the point that they're almost too conservative. And then when earnings are actually reported, you get beats. You get companies that beat their estimates. So again, pretty optimistic earnings for next year. And then here's just a depiction based on sector. So you look at the blue bars, if you will. That was the first quarter. Second quarter we know is going to be bad. That's in kind of that lime green, and then the slightly darker green, if you will, is the third quarter, and again fourth quarter. So you can see that trend. It's in the first quarter of 2021 is in that positive kind of a grayish blue aqua colored bar, if you will. And now you can see that that the decreases in earnings, at least, software, we're looking for some negative traction in software, but not nearly as bad. Biotech, you're going to get fairly strong bumps at the beginning of next year. And then if you look at revenues, both software and services as well as biotech are definitely going to be contributors positively to the S&P 500 revenue numbers. And finally, a couple of, I won't spend too much time, but basically a couple of charts on from BKA research, which I thought were pretty interesting. One that shows globalization overall. I think we've read that, with trade wars with China, increased protectionism, for many, 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 many years, we were pro-trade, free trade, trade pacts, NAFTA. We were discussing at the end of the Obama term the Trans-Pacific Partnership, TPP, and some other trade deals. And we've really kind of had a bit of a reversal as we kind of tread into into 2020, and I think COVID-19, with the pharmaceutical dependency on China, it's just indicative of just one example of how this trend is likely to continue. And I think it's important to understand too that increased globalization has a fairly strong correlation with lower inflation. That increased globalization has been tied to keeping inflation low, and so as we kind of unwind that a bit, it'll be interesting to see if that translates into higher inflation because higher production costs, because we're not betting as much on the economies of scale as much as we are kind of protecting our own national interests. Resurgence of nationalism versus anti-nationalism. This chart has not a whole lot of significance as it relates to our view of Russia, but it's just interesting, again, from BKA research where, I found in reading one of their pieces here lately that in Russia, the view of Russians as a great people versus the view of Russians that are basically no different from anybody else, it's really spiked as of late. So, I mean, this nationalistic pride, if you will, is kind of taking a little bit more root in Russia, where at the same time you can see a consistent slide in the U.S. as we've become seemingly much more partisan and less able to agree and come to consensus on things. So just a few charts this week to hopefully tantalize your interest. As always, appreciate your comments and suggestions, and be sure to look for our market minutes, which will talk a little bit about our feelings on the market, perhaps what we're doing in some portfolios, and again, addressing some of the major themes that are driving our investment markets these days. So hope you've enjoyed this installment of Charts of the Week, and hope you have a wonderful week and stay safe.